Right, in this chapter I want to talk about another way of improving our trading and avoiding the problems that we've already mentioned with the MACD and the stochastic. And this is a rule of interpretation that I use. Again, it's a practical rule, which is don't enter a trade if the MACD is falling, a long trade going upwards, buying. Don't enter the trade if the MACD is falling, even if the stochastic shows a bullish divergence. Remember I said I'm really into bullish divergences, and we'll get to them in a second. But my point is, if the MACD is falling, like it is here, and by falling I mean something which is going, as I mentioned before, quite strongly, there's a trend on the MACD line, and the signal line is relatively weak as well, and relatively far apart from the MACD, as you can see there. So you can see how the strength of that fall is made quite clear from the MACD, even though here we've got a bullish divergence. In other words, the stochastic has made a higher low, but the price has fallen. Yeah? So you might have thought, wait a minute, higher low, so around this we want to buy because, look, the price has gone up, we've got a higher low, we've got a bullish divergence, but what gives it away is this. Look at how fast that MACD is falling. That strength of decline says to me, stay away. I don't have all the odds in my favour. Now, it might be that the MACD might have turned around, this would have gone up. What I'm talking about is odds. It's not that this never works by ignoring this rule. What it is by sticking to this rule, the odds are more in our favour that we won't get into a trade which gives us this slight rise and then moves off. And you can see it here. It's been falling, has a slight rise. People get in and then it falls off and it takes them down with it. Just when they thought they had a bit of a saviour, and just when they thought that saviour had come in the form of a bullish divergence. But no, how did we see that it actually wasn't a good one? Because we looked at the MACD, and basically we don't enter if the MACD is falling, even if the stochastic shows a bullish divergence. That's, again, as I say, to enter long. And the opposite applies as well in terms of going short. Don't go short if the MACD is rising fairly sharply, because, as ever, the MACD overrules the stochastic. So that's one of the key cons that we want to avoid. Another one, which again reduces the probability that we're going to enter into trades which knock us out, don't make us any money, is avoid charts that simply don't work. And by that I mean, when you look at the charts historically, if they're moving around, they're quite volatile. Look at the daily patterns here. It's down, then it's up, then it's an inside day, then it's up again, then it's down. Basically, it just shows no clarity. It's down, it spikes upwards, quite long. When you just look at the price, you think to yourself, well, wait a minute, where am I going to put an entry point? Where am I going to put a stop loss with something like this? It's a mess. Even when it's going upwards, it's got lows, hits a 3 or 4 day low, and then moves up a bit, down, up. It's a complete mess. It's not smooth. Charts that just look a mess like that, which because they're volatile, because the bars seem to be all over the place, jumping down, i.e. too random, ignore them. Don't try and look for patterns. Don't try and interpret things. The idea, when they're not there, the idea with the MACD and these other indicators is not that they should give you an answer to everything all the time. The idea is that at the extremes, imagine all share performance is on the x-axis over here, right? And you've got all the range of performances in what's called a normal distribution. In other words, you've got some which are doing really badly, the vast majority are doing fairly well, and then you've got some which are doing really well. We're just looking for the MACD to help us for these, not to give us an interpretation for anything and everything. You could show me a chart and I'd say to you, well, you know what? I don't know. Off the back, and it's not just a momentum indicator, it could be anything. It's the vast majority of stocks, 80% of them will be uninterpretable. They will be meaningless. It's when we're looking at extremes, i.e. we're looking when the odds are stacked in our favour, we're looking for the extreme trades where we think we're about to enter into a trade. That's the ones that we're trying to save ourselves for, where we want to use a MACD interpretation or a momentum interpretation, not just any Tom, Dick and Harry and any random chart that we might come across.